Now, the Eurozone economy is not growing as fast as economists had expected. The region grew just 0.2% in the latest quarter. That's half as much as expected. And inflation remains a problem. It stayed below the level that economists say is needed for growth, but that's also putting pressure on the European Central Bank to ease monetary policy when it meets next month. Breaking it down by country, Germany was the main bright spot as Europe's largest economy grew 0.8%, but that failed to offset the weakness elsewhere. Spain notched up slight gains, but less than some had hoped. France failed to grow at all. And the government there is under pressure to turn things around after introducing tough austerity measures. Then there's Italy. They slipped into negative growth. I spoke to Jacob Kirkegaard, economist at the Peterson Institute for International Economics here in Washington, and I asked him if the dip in the global markets on Thursday has anything to do with the tensions between Russia and Europe.
The EU GDP figures was a major negative surprise, basically half of what consensus was, 0.2% for the first quarter, which more or less guarantees, in my opinion, that the ECB will ease monetary policy at the next June meeting. And all of that had to be priced into the market. And then, of course, on top of that, you had similarly bad numbers. I wouldn't say not necessarily as unexpectedly bad numbers out of Russia, but it all added up to gloom, both in emerging and advanced economies.
How much of this concern is related to what's happening in Russia, what's happening in Ukraine, the sanctions imposed by the West? Is it too soon to see an economic impact, or are we already seeing something?
No, I mean, I think the Russian numbers clearly illustrate that, in fact, while many people have been dismissive of the scope and the type of sanctions that have been imposed, but I think we're starting to see now that they actually do have a significant negative impact on the Russian economy. On the other hand, I don't think the bad numbers in the euro area as a whole are particularly related to the issue in the Ukraine, because the really negative surprises in the euro area came from France and Italy, none of which have a huge economic relationship with Russia.
And then also the impact on the other side, the whole boomerang effect that some people are talking about. How much does it impact the companies in Europe?
No, I mean, there's no doubt that if certain companies that have particularly large investments in Russia, they're vulnerable. Some of the banks that have significant loan exposures are vulnerable. And then you do have these countries that have significant cross-border trade with Russia. This means the Baltics, in particular, Lithuania is probably the most exposed of those, and those countries that have very significant energy dependence on Russia, particularly Slovakia and Bulgaria. Those are the ones who are most exposed.
Some of the critics that we've spoken to, experts on the show, have said that these sanctions are weak, they're not very strong, it's not likely to have a very big impact, and perhaps what they mean by impact is changing President Putin's sense of direction here. But we are clearly seeing an impact, at least on the economic side, in many places in Europe. You've highlighted Russia as well, and might we see that impact to the rest of the world? Is that a legitimate concern?
I don't think so. Not as necessarily directly related to the sanctions, but I think you could have a sort of broader confidence, undermining of global economic confidence. Is the sort of, well, what if the whole thing spins out of control? Well, I'm just going to hold off from investing because of this uncertainty issue. But that's more related to the sort of geopolitical tensions that it highlights than the fact that a number of Russian individuals and firms and banks have been sanctioned.
The president of the World Bank, at a speech this week, spoke about the situation in crisis in Ukraine, saying that if it got worse, it would have a ultimately a long-term impact, obviously on how investor sentiment is and the economic data that we're seeing. Do you agree that there could be a longer-term impact, or do you expect this to, hopefully, I guess some are saying, only a short-term impact?
If the sort of status quo was allowed to prevail, namely that a large neighboring country, aka Russia, could simply militarily take over border provinces, Crimea and the eastern part of a neighboring country in Ukraine, that would be a terrible precedent. It would undermine essentially entire post-Cold War era. And would have, I think, long-lasting implications for many emerging markets.
The markets, surprisingly, with respect to today, has been near all-time highs. It seems at least global investors have isolated that situation in Crimea and Ukraine and been able to let that be for now. When do they start to worry? When do they need to worry?
When you reach the point where the crisis, in their opinion, gets worse than what the central banks can manage by quote-unquote printing more money or lowering interest rates. And we're not there yet. I mean, I think it's correct what the markets are saying. I think the current situation in the Ukraine and Russia will stabilize where we are. It will be bad, but mostly for Russia itself.
Jacob Kirkegaard, economist at the Peterson Institute for International Economics.